The Federal Reserve is completely and entirely responsible for what happens in the stock market. There are no other forces which can overshadow what the Fed is doing. They increase rates, and that causes a slowdown. Everyone from the mainstream media all the way up the ladder of the current administration to high-level figures in finance are begging the Fed to stop increasing the Fed funds rate. They know exactly what is about to happen. Increasing rates will in fact crash the stock market. There are no alternative possibilities. Do you think the Fed will increase further? You came here for the truth, so let me unveil that for you. I've got a set of charts that I find very interesting, and I'm sure you will as well. So we're going to get into this today. We're going to talk about all of the factors which are about to be laid out in front of us in the coming days, weeks, and months. This video is being recorded just before Monday's trading session. We're sitting here after a few weeks of turmoil. And the most important factor, besides the trade issues, besides what's happening with this midterms, we've got the Fed and their actions. And that really is central. The blue line you're seeing here is the effective Fed funds rate. That's essentially, for those who don't know, interest rates, okay? The most important interest rates, not just in the United States, but this rate here has such an impact on the entire world that we've actually had multiple central bankers from other countries say to the Federal Reserve, please do not increase any further, because doing so will have an impact on our country. That is an admission from multiple central bankers. I've covered it before here on the channel. And what you're looking at is the Fed funds rate in blue and the Wilshire 5000 total market full cap index in red. And essentially the entire US stock market, instead of looking at the S&P 500, the NASDAQ, and you get a different idea, although they do generally move up or down together. This gives us a much wider picture, and you'll see something interesting here. Whenever there is an increase in the Fed funds rate, as you can see, leading up to the financial crisis, the housing crisis, they saw what was happening. They saw the economy overheating. They saw the housing market overheating. They saw what was happening. They started to increase rates. In doing so, the gray area here, you can see that this recession followed. All right. The Wilshire comes down as a result. The same thing happened here leading up to the dot-com crash. A little different. I mean, there's two stages to this, but essentially we have the same issue. Increasing rates, stock market crash. Increasing rates, stock market crash. That's the general consensus for what will happen. There's an inverse relationship in between interest rates rising and the stock market, and you can see that clearly here on the Wilshire, but look at anything. Look at the S&P, look at the Dow, and you would see similar information. I like looking at the Wilshire because a lot of people say, oh yeah, but why aren't you looking at the NASDAQ? Oh yeah, well, why aren't you looking at this and that? And it's good to show them all. Sometimes I just show you the Dow. Sometimes I just show you the NASDAQ because I like to get into it all. I don't want to just focus on the Wilshire. I want to get into every single thing I can to be able to prove my point, not in one video, not in 10 minutes, but I prove my point over literally hundreds and hundreds of videos. And for those who are sticking to it, they start to piece together this very, very strange puzzle. It starts to make a lot of sense, but you have to be in it for the long haul. Now, this here is something that connects in with what I talked about in the introduction. And we're looking at the Fed funds rate. It's going back to 1980. Obviously, that's the peak. But what's interesting is that in these previous cycles where you have the Fed funds rate increasing, they did so at a relatively quick pace. Look at these instances here. Throughout the 80s, you can see that line going into the 90s. The pace is rather quick. I personally think it's still too slow, but you can see that it's quicker than what we've seen during the mid-2000s. And especially right now, not only did it take them longer than ever to start increasing, the first increase here was December of 2015, if I remember correctly. Brought it up to a quarter of a point. So we're looking at this being not only the longest it ever took, but the slowest increase. And you already have, as I mentioned in the introduction, all the way up the administration, you have bankers, analysts, individuals like Jim Cramer, and all of the talking heads, and everywhere you look, Federal Reserve, stop increasing rates, you're going to crash the market. Federal Reserve, look at the warning signs. Another increase in rates is going to start to slow things down. Don't do it. Don't do it. And how many times did we hear this before? Other central bankers like Volcker, like Greenspan, they've both admitted to having individuals coming to them saying, please don't increase rates because it's going to have an impact. And of course it will. That's the whole point. You want it to slow down the economy. Look, they could have kept that housing bubble going even longer. They didn't even need to have a dip. They could have just kept it going for another 10 years if they wanted to. Housing prices could be at $10 million each. But they realize what the result of that would be. And so they slow it down. Now, that's surface level. If you want to know what I actually think, let me just interject it for a second here. The central bankers work in collusion together with the technocratic elite and the individuals that sit in the shadows, and they intentionally create a crisis. That's just me, but you can ignore that information. Okay, let's get back to this. Looking at October, Shocktober was, by any measure, a terrible month for global stocks. $8 trillion wiped off valuations here. Look at that. $8 trillion. In fact, it's the worst since 2008. So it is a significant drop, but a lot of people don't want to admit that. I, for one, I know that if you're a regular viewer of this channel, you agree with me. You just want to know what's going on. Let me know. Is this good? Is this bad? What's happening? Why is this happening? And so on. So this right here shows us that the market has indeed come down a significant amount. Now, when I say the market, what am I talking about? Am I talking about FANG stocks? Am I talking about my Apple stocks? Am I talking about my 7 shares of Amazon? No, I'm not talking about that. I'm talking about global stocks. There is a global market out there that we should all be paying attention to. There are stock markets all around the world. And we can't just focus on one. All right? Total amount of interest paid on public debt each day in G7 countries. You'll notice something very strange here. It's that while a country like Italy is certainly higher than France and Canada and the UK and Germany, Japan, there's one very, very serious outlier in this group. One of these things is not like the other. You've probably heard that before. And the amount of interest paid by the US is astronomical. It's 10 times higher than what Italy is paying. And they're paying 3 times more than what France is paying. The next level up. So we can see that we have an issue here that cannot be resolved. They've got problems right now, and the higher the Fed funds rate is, that affects everything to do with interest, everything to do with debt. So it's not just the Fed funds rate and what that means for the Fed funds rate. No, we're talking about everything: mortgage rates, car loans, interest on the national debt, interest on all of these different, trades that are happening today. Big time worries right now. And this is happening not just with the Fed, but it's also happening all around the world. Central bank balance sheets, something I show all the time. The liquidity is in fact drying up at a scale that I didn't think they would accomplish, but as far as I'm aware, by the end of the year, they will have completed their goal of $1 trillion wiped off from global liquidity. We'll see if that's going to be the case, because of course they can reverse that. There's still 2 months left here. But the ECB, Fed, and BOJ, BOE, the Central Bank of China, and so many more are all printing money throughout the financial crisis up until today, but things have changed. They've slowed down their purchases. Some central banks have actually started to wean off their balance sheets, but year-over-year growth turns negative in the first quarter of 2019. So I'm going to bring this to you and show you what's happening. It's already had an impact on the global markets as far as I'm concerned, all right? Now, the U.S. equities versus the U.S. Treasuries correlation, the last time we saw this, that are going into positive territory, was 2006 leading into 2007. So just something I wanted to show you. Whether or not it's going to be a factor doesn't really matter to me. I just wanted to show that to you if it's of any significance. And this here is some positive news. I know that there's a few out there. Where's the positivity? Well, equities have historically rallied strongly around midterms. All right, returns around the midterm election periods. Looking at this right now, the median has been 8% in the positive. So we'll see. We'll see what's going to happen here. It's up in the air. I'm not pointing to up or down or anything. I'm just showing you here that the market tends to rally during this time frame according to these statistics by Deutsche Bank. Okay, that's all. I'm going to finish the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. So I'm going to just let you know that if you want the financial education that you were not taught in school, these 2 books have it all. You can actually look through these books. There's a link in the description of the video. You can check that out. I get into everything to do with the financial industry, everything that you need to be able to manage your own money, to ask the right questions, to figure out what it means to handle your debt, to pay your expenses and everything else. So check that out. Link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.